but you can use it in the right way or the wrong way. And so he's going to go through how we can hopefully use it in a much more efficient way. If I can get his.
I was going to use a slideshow. Maybe not.
Yeah, we're going to use it. Okay. 3, 2.
All right. Well, thank you very much, Steve. Yeah, this is actually, my talk started off, I think, with one focus in mind, and that was to help you maybe understand how to go out and sell some of the long-term care products. But as it went along, I think my eyes were opened to some exposures that we actually have as we try to do that. So now what I'm going to do is kind of go through some of the different options, some of the ways the industry is going. And it is going to be a pretty high level because there's no way to condense this into just a few minutes to have that topic. So what we're going to do is, as we talk about each of the areas, it is going to be pretty high level. There's going to be some bullets saying some of the advantages, some of the disadvantages. So as you have questions, we will talk about those. Let's try to get through the product discussion. The only reason I say it is because some of it's going to overlap. And I do want to get to a point where we kind of start discuss, have a little bit of talk about some of your exposures that you really need to be aware of for the clients. Again, like I said, a lot of this was news to me, and it is very important. So again, Steve wanted one thing. We're going to get most of it, but it's going to be a different, a little bit different avenue. And I've been selling long-term care insurance since 2001. So I came along in the days where you're going out selling $50 a day plan or $100 a day plan, 5% compound. I mean, just whatever it is, just to make a sale so that someone could say they had long-term care insurance was kind of our focus. And there's been a whole lot of change in 16 years. So let's go ahead and get started. First off, I normally like being the talker right before lunch because everyone actually looks a little bit more excited, even though it's more for lunch coming instead of what the topic is. But so, why plan, for long-term care expenses? You know why, so I'm not going through the numbers. I mean, what the exposures are, you know what it can do to your assets. You just had this conversation. And long-term care planning is not necessarily insurance. It is simply how are you going to fund your plan? How are you going to fund your stay? It may not be insurance, it may not be annuities, it may be the family getting together, drawing up a plan of action because that is their only chance. So make sure people understand that. When you go out there, your first job is to find out their situation. Then you may pass them off to an attorney and say, you guys go figure it out because I can't help you financially. That's an honest approach. What motivates people? And I'm not talking the emotional side. We're talking they have assets to protect. Their assets are not liquid, or they're going to have a negative tax consequence. Or they don't have the means or the resources to pay for the care, but they want the freedom that does come with that. And a lot of times, the children become the person you're going to speak with because the children may recognize it. They know that either they're going to pay for a plan or they're going to come up with that piece of paper that's going to schedule out who's got mom and dad on what days. So the children may very well be involved in discussions. What are people looking for? Well, first off, they don't want to waste their money. I'm sure y'all all heard that. Especially, they're not going to need it. So why would they waste their money on something they may not need? Because they're not going to use it. They want to insure the entire exposure. They don't want the thought of running out of the benefits they've been paying for. So they want to insure that even 30 years from now. Or they don't want it at all, a lot of times. And they're willing to spend at least $100 a month. But they do want all the exposure covered. But they're willing to go up to $100 a month. And then the ones that are most willing to write the check today are the ones that would not qualify on their best day. Those are the ones, they want you to come out. They want to talk about long-term care, and they would write the $2,000 a day check or month check but you have to pick up their oxygen hose, move out of the way to go get their checkbook for them. So yeah, that's what people are looking for. And normally the ones that call you or called me 4 or 5 years after I went out and they told me no, used to I get excited when they would call me and say, come back out. My first question now is, what has changed? Normally, it's too late for them. So how is long-term care, how's the cost paid? You start with self-insuring. Everyone has a plan. Their first plan is self-insuring. They have 100% of the risk in the beginning. So where do we go there? They can totally transfer everything, transfer 100% of the risk to an insurance company or another person. Most people end up somewhere in between. When the risks they retain, they're going to pay for that either through income or through assets. When they transfer it, they're going to go ahead and go traditional long-term care, asset-based long-term care plans, life insurance with chronic and critical illness riders, a true critical illness plan, and Medicaid. Now keep in mind, the products that are geared more to riders for chronic and critical illness, they're not true long-term care plans. And while they will offer benefits that you may be able to use, you cannot count on them. What if that long-term care stay was not the result of a chronic condition or critical illness? Maybe you had a wreck and you needed there. You know what? You may not trigger your chronic or critical illness benefits. Therefore, you can't, I circle those because you can't count on it. But they can be part of the solution. And who can tell me what the best long-term care plan out there is? What's the what? The one that works. Exactly. It's the one you have in place when you need it. Okay. Whatever you've got in place is the best one out there. Now, assuming you can make it work. That's the other part of it. So how is it paid? Number one, as we said, the number one method, self-insuring. This approach also brings Medicaid into play. Because when you're out of it and there's nothing else, you know where you have to go. Traditional long-term care, as we said, asset-based solutions. Now, when we look at asset-based solutions, and people like Andrew and Aaron, they're really the ones that are going to have the details. They're going to know how to tell you the ins and outs of the products because they can be more complicated. But it's worth learning them because it can open some doors when you position it right away. Hybrid life insurance, true link benefits, things like the Money Guard from Lincoln, okay? Or AIG or John Hancock with the true long-term care riders. Those are true life insurance, asset-based life insurance or hybrid type policies for long-term care. Now then, annuities are actually a very strong option as well. And I may not use the right words, but you've got an income acceleration aspect to one of them, like an F&G product. They've got money in their income account, and Andrew can always correct me on this. They've got money in their basic account, and they've got also an income accumulation account that will be used if they decide to annuitize it and bring it into income. And if you qualify or trigger the long-term care aspect of one of these plans, you're not getting additional money for the most part. What you're going to get is access to your money faster. Now, you can get more money than what you actually put in if at the end of the time that you have exhausted that accelerated benefit or income acceleration, you then continue to live and the income is coming on for life. If you live another 10 years, you're still getting that income even though you've exhausted your resources. So you're accelerating access to your own money. You're not getting additional benefits. Now, there are some out there that are more of a benefit multiplier, similar to the Money Guard, whereas you put in $300,000 and you might have a $1.2 million available long-term care benefit. Technically, a lot of times these are annuities. Yeah, so maybe like, sometimes it's really an annuity funding a life insurance policy. I mean, regardless of the mechanics of how it works, you actually get a multiplier effect on what you put in to the annuity. So those are your hybrid type risk transfer methods. Then again, we go back to life insurance with critical illness. These aren't long-term care, but they can't be excluded from the conversation because they can be used as part of a plan or sometimes in conjunction with the other plans. You may take a smaller long-term care plan and then overlay it with something like this. So you can make them work together. A critical illness policy, again, it's not long-term care, but it can still provide upfront money in certain situations. It can be used at your discretion for care. And traditional. So what are some of the advantages and disadvantages of traditional long-term care? So the advantages are going to be it's well known from an agent standpoint. Everyone knows they need it. Well, there can also be a negative to being well known. There's a lot of negative connotation to it as well. It's pretty straightforward on benefits and triggers. You know how much money you have, you know how much you have access to, and you know what's going to cause you to be able to use your policy. It's flexible in your design. You can make it very bare bones, or you can load it up. If they can afford it, you can put a whole lot on it. But so you can customize it to fit the person's unique situation. We even now have shared benefits available, so you can have basically smaller pools of money combined, so you can leverage a smaller policy and not have to take out two larger policies. And just understand that one person may leave the other person with very minimal coverage. But still, if that's the best way to go, it's the best way to go. You can guard against inflation. You've got partnership benefits now, as you know, that will allow you to shield a portion of your estate from Medicaid if you have taken advantage of, if you put the properly designed product in place. Yeah.
Long-term care partnership plan, qualified plan for long-term care, it actually does give them access to Medicaid that they otherwise would not have access to. So if you have limited benefits or limited assets and they can afford and qualify for a long-term care plan, and that opens the door for that.
You're exactly right, and taking that another step is a lot of times what you're going to do though is when you come into the door in that situation, if that person does have the limited income and asset means, they very likely may not pass suitability these days. But you're in the house, they're already concerned. You go over to like a hybrid life insurance or something that is going to not be, it still can be the right tool, but if they don't have to pass the means test or the suitability test. So sometimes you can open the door with this and then go the other route. So having all of these different tools in your bag is important. And sometimes now also, they talked about continuing care communities now. Some of them will require you to have long-term care to enter. And so it is a requirement, or you have to have an additional funding source set aside that is assigned to them if you don't have long-term care. So it can actually be a requirement for some places. So we've got some disadvantages as well, as you know. Its reputation for being expensive, history of premium increases, difficult to use. I'm going to waste my money because I'm not going to need it. Difficult to qualify. Underwriting. When I got into this business 16 years ago, I could get almost anybody approved. But that's also why most of the companies are gone at this point in time too. Today, I don't know what the statistics are, but if someone waits till they're 65, I don't know, it's 30-something%. I mean, it's some crazy low number. It's probably higher than that, but it is difficult.
It's in the 30s.
I was thinking it was. So, and again, here you go. If they're in there and they're looking at this and they can't qualify, head over to some of these other means. You're going to have the resources to do it. Okay, so then the asset base, we briefly mentioned those a second ago. Linked benefit, you got your advantages. You will not waste your money as long as you don't lapse the policy or withdraw it out. There will be a benefit that is received from this policy. It's less stringent underwriting. These policies do have knockout questions. but it's less stringent than what you're going to have in traditional long-term care. And a lot of this will stem from like a money guard. If you're going to put $100,000 into it, okay, first off, the insurance company is using your $100,000 first, so they've got less at risk. So they're going to go through your, and if you start looking at most people don't stay beyond 3 years. Okay, well, all of a sudden, you're sharing that risk in this because they're using your money first. Protection from premium increases. They can't go up on your rates. So you've got that locked in. You've got access to your money. Now, this will affect your benefit structure, but you do have access to the money once you put it in there. Okay, I wasn't sure what that was. Eliminates the risk of lapse. People, they don't want to lapse their policies, but some people do. But this way, if you leave it, it won't lapse on you. Benefits are tax-free in most cases. I won't go through the asterisks. You can fund some of these over an 8 to 10 year period. So if they don't have a big lump sum to come in, some of them will allow you a shortened pay period to fund it. The premium, the return premium is usually built in on these products. The long-term care benefit is a continuation benefit. So in other words, you're going to get your death benefit, but then the long-term care part is greater than it. So you're getting additional to your life insurance. The triggers and the payout structures are very similar to traditional long-term care, so it's pretty easy to understand. But you got your disadvantages as well. For a lot of them, there is a large upfront premium requirement. Even if they can, people just have trouble sometimes turning a lot of money over, even if they've got the money. A single life in most cases. There may be a couple out there, but in most cases, it's going to be a single life. Well, I may have found one yesterday, but I'm not sure. I don't know. I wouldn't go there yet. Withdrawals will affect available benefits. The death benefit usually decreases with time. In other words, as you get older, the amount you have in your death benefit will be lower. The maximum benefit does not adjust for inflation. In other words, while your daily or monthly amount may increase, your overall pool is not going to increase with inflation. You can draw it out faster over time, but you're not going to have more benefit over time. Your lump sum amount cannot come from qualified funds. You can't 1035 your IRA into this. You can liquidate it, pay the taxes, and then fund it, but you can't do a 1035 into it. State Life will take qualified money into their annuity.
Pay the taxes.
I'm talking like a money guard type product. This is the life insurance side, not the annuity side. A lot of people see the opportunity cost of the investment. Okay, if I don't put this in here, I'm going to make all this other money. So that's just a mindset thing. As far as the state partnership plans to protect from Medicaid does not apply to these products at this time. And again, you also have a lower death benefit. If someone's ever looked at a single premium life insurance policy, they're going to have a mindset of, oh, this is not as I'm not getting as much life insurance as I have elsewhere. Yeah. Yeah. Mm-hmm. In total, I need to go back and reread my illustration. I messed up my illustration then. I saw that going, yeah. And I made a mistake. You're talking about the total and the monthly. Okay. Yeah. 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 Mm-hmm. Yeah. Well, that's part of what I'm saying earlier today is this is not so much how to sell long-term care, what to be looking out for. Now, the other side of the hybrid is more of like a John Hancock or an AIG policy that's going to give you an actual long-term care benefit as a percentage of your death benefit. So in other words, instead of having a multiplier on your death benefit, you're simply going to use your death benefit at a percentage advance. In other words, you're going to use like an accelerated death benefit amount. Again, similar ones. You're not going to lapse your policy. It's less stringent underwriting. Protection from premium increases. Benefits are tax-free. This one now, you don't require a large upfront premium. You can pay it annually. You can just pay it like a regular life insurance policy. And so that's attractive to a lot of people. You can have returning premium on some of those. The triggers and payout structures, again, are similar to traditional long-term care. So it's not going to be a complicated explanation. Disadvantages, single life. Partial withdrawals of cash value will affect your benefits. Maximum benefit is not adjusted for inflation unless you have a increasing death benefit. You can set that up, but for the most part, we don't see people doing that. Premiums are not tax deductible with respect to long-term care deductions. Now, if you have them set up some other way, maybe, but state partnership benefits, again, do not apply. And this is not with respect to long-term care deductions. Yeah, they're still using the severe cognitive impairment is now the going definition. So it is a little bit, it can be different, but again, that's the whole thing is you use it, but you make sure you understand it before they buy off on it. The annuity side, we're going to have some very similar, I mentioned the income acceleration earlier. Some of the, now the annuity side is going to be, you can have multiple annuitants. So you can have two people on the same policy. If you go through all the benefits, well, the surviving annuitant can still continue that life stream. So you can very well exceed what you have in the policy if you have two people on there. You have access to money, though it will change the benefits available. Eliminates risk of lapse. Qualified funds can be used. So, you're getting some a little more flexibility in there. And Andrew, you can stop at any point. An upfront bonus may be available. Keep in mind, if you're getting a bonus on these types of annuities, it's not going to be the bonus. If they get their statement, they're going to see a 10% increase on their account value. There's an income account. It's kind of like I call a shadow account. Works in the background to grow your income out of. That's where the bonus applies. But that person may call you up and say, "You told me I was going to get a 10% bonus. Why doesn't it show up on my statement?" Because it's not going to be on their account value that they see. Is the account value the right word? Is that the left-hand side? The income value is the other one. Is that okay? Okay. Yeah. Okay. Good. Okay. So that's right. So your payout may exceed your value. Also, if you look at the income side of things, the income value, it's going to have a higher guaranteed crediting method over time. So this could be actually a decent or good sales idea to take someone that's got money and they want that concept of creating your own pension. Put the money in early, let it take advantage of the income growth of these higher crediting methods, and then it kind of builds in. It's either it becomes their pension, and also can be their long-term care as well. But emphasize the increased guaranteed rates on the income side. So it can be the pension creation sale as well as the long-term care sale. It's an indemnity type benefit. It's your money. Use it how you want to. The longer you delay the start of taking your income, the higher it's going to be, obviously. Speed up a little bit here. Large upfront premium. I say large to be meaningful amounts. It's going to have to be a little bit. Partial withdrawals will lower the future income. Future income is not really protected against inflation because your pool, well, it's protected against inflation in the sense that the longer you wait, the higher it goes up. But once you start receiving your income, it is then not going up with inflation. Ordinary income tax applies to withdrawals. There can be up to a 2-year waiting period to use the policies, or the annuities. I'm just going to run through these because, again, you've got similar benefits. However, with the annuity that's going to give you the benefit multiplication, think about it. If you got a 3 times multiplier and the person puts in $50,000, well, they've got $150,000 for long-term care benefits. $100,000, they got $300,000. That's a meaningful number. So you can leverage smaller dollar amounts in something like this. Multiple annuitants, again, can be allowed. Less stringent underwriting, access to your money. Eliminates risk of lapse again. Qualified funds can be used. Okay, you're going to have your tax implications on it, but again, you can use qualified funds in this. What do you mean? There are going to be knockout questions. You can't have Alzheimer's and go dump your money in here, and then in 2 years get that 3 times. I'm saying there are some knockout questions. I'm saying, but when you qualify, you can't already have these conditions to take out the policy or the contract. Disadvantages: upfront premium requirement, partial withdrawals affect death benefits, withdrawals, taxes on your income. A lot of now, like the state life, 59.5 is the youngest you can do these policies, these contracts. Surrender charges can apply for the withdrawals. Now then, here's what I really want to focus a little bit more, make you aware of, because this is where people are going to start getting in some trouble if they're not careful. Critical, this all sounds really good. You make the sell, but you're not using a true life, long-term care rider on the policy. You're not going to waste your money. Okay, there is no additional underwriting. This sounds really good for these type riders because it's on a traditional life insurance. Protection from premium increases. Access to your money if it's a permanent product. Benefits are generally tax-free. You may fund over a limited period of time or a longer period of time. That's what I meant to say because it's pay as you go. Return of premium available. This all sounds really good. Premiums may be suspended or eliminated after the trigger. I mean, depending on the company, these things are good. And it can be available on term products. It doesn't have to be a permanent product to have some of the chronic and critical illness riders. Disadvantages: single life, partial withdrawals of cash value of benefits. Maximum benefit is usually not adjusted for inflation again. Premiums are not tax deductible for long-term care. Maybe significant cost to exercise. We're going to look at that because that's understanding that may keep you out of court. Benefit determination can be complicated and unknown. It is like a black box sometimes. I had a stroke. You let them know that. They get the medical records, they talk to the actuaries, they talk to everything else, and they come back with a number. Some of them may say it's $50,000 if you have a stroke. Some of them may say we'll get back to you and let you know. So it's not as cut and dry as you might think. This next slide is not an endorsement or criticism of any particular company. As professionals, it's imperative that we understand, the fine print of these solutions that we're recommending. It ensures that clients know what to do, what they're doing. It ensures that they're going to make the right decision given their circumstances. And it also protects us from being sued. And it's very important. But the main thing is let the client know what they're doing. People will make the right decisions usually when they're given the right information. Even if it's not as positive as they want to see, let them make that determination. Don't keep something from them. And if you intentionally leave out this stuff, you need to leave the business because you're going to hurt people. I mean, it's that simple. If you know these things and you don't explain it, you can hurt people. It's not good. So what's the situation here? Critical illness. I'm going to give you an example. And I have the specimen policy. I have actually had the company run these illustrations with these riders exercised. Okay, I'm not giving out the names on it. But picture this. Okay, your triggers, they usually require for critical illness, a degree of severity. You heard this yesterday, and the guy from Allianz, I will tell you, he did a good job of saying, be careful. Here's why. First off, degree of severity, first occurrence, may be used on multiple situations. You might have a heart attack, you might have a stroke, you might have Alzheimer's. Well, you can use it for all three. You can't use it for the same one more than once, though. That's the way they're going to work that. Okay, so, and it's got to be within the total amount. Benefit payout. It can either be a flat amount or, like I said, that black box that's going to tell you when they get back to you what the payout is. Cost to use, be careful. They may say it's a flat fee, up to $250. But they may not exactly tell you that they put a lien against the death benefit. They're going to charge you 8%. I think they did tell you that yesterday. They're going to charge you 8% interest on that lien. So if you do this early in the contract and leave it in force, you don't pay your interest payment, you're going to have a big surprise 10 years from now when you go to exercise this, when you thought they only took $50,000 out of your death benefit. That's not the way it works. Some companies keep a discount amount. In other words, it's not a percentage, or it is a percentage. It's not just an interest or a flat fee. They keep a significant portion of it. Okay, you're also, and then we mentioned the interest charge. The chronic illness. What's going to happen here is generally the 206ADL, severe cognitive impairment, that may require permanency in there. So the benefit payout is usually a fixed percentage. It may increase the payout, the longer you wait before you use it, the payout may increase. Again, here's where you got to be careful. The same exact type of a setup. The annual interest charges are surprising people, and they keep a portion of the money. So now, and also, you got to, accepting an offer may terminate the contract. You think you're getting a portion, and the rest is going to stay in there. If you take their full offer, they may cancel the contract at that point, not just deduct that from the death benefit. That's not always clear. Okay, here's what I actually received from the company. Okay, you got a $250,000 death benefit, a 60-year-old male, acceleration, actual payout is this. At age 65, they accelerated $50,000 of death benefit against the policy. See that number in red? That's the check they write to the client. That is their discount factor that they keep in their own account. So they're going to take the $50,000 out of the death benefit. But the person is getting a check for $20,000. This right here is what it exactly says. This is straight out of the specimen contract. The critical illness benefit calculation uses 40% of the death benefit accelerated regardless of the gender and the age, all that kind of stuff. This percentage will not change for the life of the policy. You use it, they're keeping 60%, you're getting 40%. Yes. Does not matter your age or severity. Okay, now then, the same company, they ran in the illustration. Next section, if you use a chronic illness rider, acceleration, they will accelerate up to 24% per year for 4 years. It's got to stay under 100%. The actual payout, if they accelerate at 65, they're going to have a $60,000 acceleration, and the client's going to get a check for $43,549. So the company is keeping the $16,000. So you're going to tell the client you're going to get a $60,000 payout, but when they get a direct deposit and they call you and say, Terry, why is my check only $43,549? You told me I was getting $60,000. Well, I think you better let them know up front that they're not getting the full amount, because that's when all of a sudden you're going to start getting phone calls from lawyers and everybody else. So again, it is what it is. Now keep in mind, this is not a perfect solution, but it may be better than no solution. As long as they understand it, that's the key. Make sure they understand it, because it's better than nothing. But see, so then as you get older now, their mortality, their life expectancy will be closer and closer. So they're going to get more and more of their money. And then we saw the interest component. Look at this. If this person uses their critical illness and they die 10 years later, okay, insured dies after 10 years of the advance, death benefit payout is going to be $150,000. Okay, well, they only took a $50,000 advance. What happened? Compounding interest. Over the next 10 years, they've just taken another interest of $50,000. So when they get the death benefit check, they're going to say, Terry, they only took $50,000 out. Why aren't I getting $200,000 instead of $150,000? Oh yeah, didn't you know? Pardon? Oh, you're right. No, you're 100% correct. I guess in my mind, though, what I'm thinking is they took $50,000 out. well, this is actually a different company than that critical illness one here. But what it is they did get a check for $50,000 less $250 charge in this one. So this particular company. Again, these are just things, this is not company specific, but these are actual numbers that I have gotten verified from the companies. So anyway, again, not a perfect solution, better than no solution, but don't sell it like long-term care. And don't sell it as an absolute, this is what you're getting. I'm gonna skip over this one. Critical illness policies, they work very similarly. They can be a good option as an alternate. Here's some sample premiums now, so we can kind of start to think about what solutions we're going to look at with people. Days of 5% compound interest on long-term care is gone, unless you've got someone that's just want to spend a whole lot of money. 5% compound, 60-year-old male. Okay, if you look at a 3-year benefit, $200 a day, 5% no share. So think about this when you start looking at the life insurance premiums, because you're going to have a couple. If they both wanted that policy, they're going to spend $11,000 on it. If they wanted 5%, because that's that person that's so worried about the future, but they're going to balk at $11,000. Most people are anyway, unless they're doing it through a business and funding it. Now, drop it back to 3%. Yeah, they have less benefit, but they've also saved $5,000 a year. Okay, and don't forget now, also, they may not like the life insurance because they're not going to have as much benefit down the road, right? But keep in mind, if you lower the amount they're going to have down the road, they're going to be paying more out of their pocket for what the shortage is. So all of a sudden, that fixed life insurance benefit may be paying them a whole lot more money. I mean, they may because they're not paying, they are paying out of their pocket, but they're paying more for the long-term care coverage. And then again, you start going back to the shared care, smaller benefits, and lower interest or inflation. You can start lowering the premiums. You can play with it for the person. I'm going to skip over the traditional. If they don't have a spousal discount, you know how that works. So if you still have an individual, the life insurance starts to look even stronger, because the individuals without spousal discounts are going to be much, much greater. Because let's take a quick look at the life insurance side of things. And think about this from a life insurance standpoint. How much is the long-term care costing you? This is the AIG product with the per diem amount. So in other words, the death benefit is going to stay at $250, but as the IRS changes the daily per diem amount allowed, they're going to have access to more and more of the money faster. Okay, that's a $5,600 premium for that 60-year-old. That's with the rider. Without the rider, it's $4,588. So the long-term care costs them $1,000 a year to have access to their money for the long-term care, or 23%. That's not that hard to swallow. I mean, if you think about it, if they don't want to buy a long-term care policy, they've got this money. If you can add 23% to the premium, but all of a sudden make all that money available for them for long-term care, that's not that difficult, of a sell. Now, if you look at just other companies with the chronic illness riders, you know what? They're not that much less expensive. Now, keep in mind, the people I have someone I'm talking to right now. She may not qualify for the AIG long-term care only because she has neuropathy and she's had to see a pain specialist. So she may only be able to go for a chronic illness type approach. I don't know. We'll see. So, and then the female, now her just like life insurance or long-term care insurance, her percentage increase for the long-term care is going to be higher because long-term care for females is higher. So, again, when you start looking at these premiums compared to the size of those long-term care premiums, the life insurance policies are going to start looking more and more favorable for a lot of people because they're not that far out of line. So we're going to start wrapping this thing up. Just a couple quick sales ideas. Multiple policies. Take a smaller long-term care policy that may be the easy to use. Don't load it up. Keep it low. And then put a chronic illness life insurance policy with it, because all of a sudden you're going to have a life insurance that they're going to use, and they can then have access to some of those other benefits to supplement the long-term care. This is especially if that person knows they want long-term care, but they don't want to pay the price for it. You can combine them, just like you might combine multiple life insurance policies. You leverage both strengths. Go ahead and get people to think about their RMDs early. You know what? Because if you talk about funding, we used to use that as a long-term care tool People look at their income. I can't afford this out of my income, therefore I'm not going to do it. But it's really protecting your assets. So go ahead and get them, draw that line in between, no, people don't use it, they want this for the rainy day. Then show an arrow coming back across the line that says bring some of your assets forward early and fund for protecting your retirement. Okay, and then they may say, well, the tax implications, but if you get them into those thoughts, it opens up the door of not thinking of it as an expense out of their income. Go ahead and start trying to get that conversation going early. Emphasize the assets, the general approach, and then on your RMDs, know the number 27.4. Ask them how much money are you going to have at 70 and a half. If they say $1 million, divide it by 27.4, and ask them, so what are you going to do with that extra $38,000? What do you mean? They may not have ever seen what their RMD is going to look like at that point. All of a sudden, then you can bring up that number, and it's linear. If they say they're going to have 500,000, just divide it in half. Okay, if it's 500,000 instead of 38,000, they're going to have 19,000. It's a linear number. Just remember that one number, and that's going to open up the door to say, in a few years, you're going to have a big chunk of new income. Go ahead, take advantage of your younger age, your health. Get this in place now, because you see when you retire, you're still going to have that coming in. And again, they may not go that route, but it at least opens up the door saying, I can go ahead and start now on that. Again, that's just a simple rule of thumb. Another point of indifference. If you take that guy that was 60 years old earlier, if he says, I'm going to make on my conservative, low-risk money, I'm wrapping up. Okay, yeah, that's a good one. Yeah. On this one, the way I've used this especially with older clients on second to die type policies, because the concept is simply this: you look at your low beta, your low risk assets, and say, what is your after-tax return on your low risk? Maybe it's 4%. Okay, if you take a 60-year-old, and you can do this, I have an HP old calculator, it's 30 years old, I can do this in 5 buttons on there. The point of indifference, what you say is, okay, if you take that $10,000 a year premium, you invest it with an after-tax return of 4%. Okay, how long is it going to take you? And I came up in the GULs for $420,000. That's with the long-term care benefit. That person's got to live to 83 before they'd have been better off taking that $10,000 and investing it at a 4% after-tax growth return. So you're going to ask them, are you going to live longer than 83? Well, there's a good chance you will, but are you sure? 23 years until it's a better decision. Okay? Open up that conversation again, because what's happening is, and I've got a spreadsheet that does, I hit 4 buttons and it shows it, because it shows one line starting at 0 with just a flat line as the premium increases. Click the next button, the line shows and goes up exponentially, because it's factoring in the opportunity cost or what you're going to make on your investment. So this one goes up faster. Then all of a sudden you hit that one button and that solid line goes across at where the death benefit is that is guaranteed. Okay? And this is all green, and you show them this point way out here in the future that says you got to get there before the life insurance was a bad decision. It's a picture that they can really see. And it's been an effective strategy for me. And I remember one evening when I had a 70-year-old man turn my computer around and started showing his wife. When he did that, I started getting the application, because once he took ownership for explaining that great picture, the sale's done. It's just a matter of starting to sign the papers right there. So that really was, that's something to consider. I call it the point of indifference. At what point do you not care which thing you did? That first 23 years, he was better off with the life insurance. The last one, someone mentioned the ART yesterday. I just took out an ART with American National for $1 million. I just got approved this week. I'm 52 years old. I cannot do better than standard anyway, because I had cancer, malignant melanoma, 24 years ago. I'm paying $88 a month. That's not bad for $1 million at 52. Okay, what's going to happen though is their term, their ART, I have the $1 million is totally available for the chronic illness and the critical illness. My daughter's got probably about 4 more years of college, so guess what? I I can walk away from this in a few years, and I've spent that much money. And I compared it to Principal's 10-year term. It takes until the 10th year before I have paid more, even with my premium increases, than I would have for the 10-year term with Principal at standard rates. At $900 extra over 10 years. I'd have paid $900 more for the increasing term rates. That's $1 million. Yeah. So that's not bad. And if you got someone that says, I can't afford this right now, $88 a month, right now.
So you're paying $90 more.
Exactly. Yeah, and on the front end, if someone's got kids in college, we need all the money we can get. I got my second one just graduated a couple of weeks ago. Now my daughter starting her junior year, but she's gonna have to go to graduate school. Need a little bit longer, but I can't afford to go out and take out a big permanent policy. I'd love to, but I can convert this one if I need to. So don't walk away from the ART. The commissions aren't as high. I don't know what I make. Terry doesn't pay me anything anyway. But the bottom line is, guys, it's a great door opener too, for businesses or whatever. When you can come in, and I'm gonna leave you with this. When it comes to the long-term care approach, start small. Make them tell you that's not enough. I want to go higher. I've seen agents come in and bring in this mammoth policy. The person has sticker shock. And then you start backing down. Now they're settling. Oh, now you're giving me a Yugo instead of the car like Doug drives. So if you start off real high, you lose your credibility. If you start off lower and they say that's not enough, then they're the ones that's driving it up to where it needs to be. But don't give them sticker shock on that. And I do have one more thing to end with. When I said earlier, we have a responsibility for people. I've seen people over the last 16 years get hurt by unscrupulous agents when it comes to long-term care. You go out in the middle of the country and you have a 75-year-old lady that's been on the family farm. She's afraid of long-term care. I've seen agents back in another company used to have a home health care only policy. They'd go out there and sell her a home health care policy when she had no family infrastructure to support her. She had no support structure in the community. That lady is not going to want to stay on the family farm with strangers coming into her house that she does not know, because she doesn't want to. It's just not going to happen. And also, they're selling small policies just to make the sell. To make it a meaningful home health care policy, this thing's going to be huge, especially if you're having to pay for around-the-clock care. Find it. Make sure the person understands how this stuff works. Ask them the questions about their family support structure and how they're going to be able to use this thing. Because if it's not there, and you go ahead and go forward with it as if they can use it, you're doing the wrong thing. You may make the sell, but in a few years, when all of a sudden it happens, they're not going to want a parade of strangers coming in to take care of them. So don't do it. help them find something else, or be honest with them at least and say, I don't think this is the right thing. Now, if you tell me, not only put that in writing, if you tell me you want it anyway, we're going to do it. But put it in writing that you don't recommend it. Okay, I blew through a whole lot real fast. If you have questions on the products, especially the annuities, Andrew does a great job on that. And Aaron, off the top of his head, will know most of the life insurance details as well. I'll do my best, and I normally go to them and ask them. So that's where I go. Cool. All right. Thank you, Mike. You're welcome.